Investing for profit can be a complex and challenging process, but the Warren Buffett method provides a tried and tested approach that has been successful for many investors. In this video, we will outline the key principles of the Warren Buffett method and explain how they can be applied to investing for profit. The Warren Buffett method is based on a value investing approach, which involves identifying undervalued companies and investing in them for the long term. Buffett's philosophy is to buy great companies at a fair price rather than buying mediocre companies at a cheap price. Intrinsic value refers to the true or inherent value of the company based on its assets, earnings, and other fundamental factors. The idea behind the value investing is that the market sometimes undervalues good companies, creating opportunities for patient investors to buy shares at a discount and realize significant profits over the long term. One of the key principles of value investing is the focus of the company's financials. Value investors look for companies with a strong balance sheet, good cash flow, and a history of consistent earnings growth. They also pay close attention to the company's price to earnings (PE) ratio, which measures the current stock price relative to the company's earnings per share. A low PE ratio might indicate that the stock is undervalued, while a high PE ratio might indicate that the stock is overvalued. Another important factor that value investors consider in the company's competitive position is in its industry. They look for companies with a strong competitive advantage or moat, which refers to a unique selling point that makes it difficult for competitors to replicate. This might include a strong brand, patent protection, or network effects. By investing in companies with a moat, investors can be confident that the company will continue to generate strong profits and returns over the long term. Value investors also pay close attention to the price they pay for a stock. They seek to buy shares at a discount to the company's intrinsic value, or what they believe the company is truly worth. This requires a thorough analysis of the company's financials, competitive positions, and future growth potential. Value investors are willing to wait patiently for the market to recognize the company's true value, which might take years or even decades. To identify undervalued companies, value investors typically look for stocks that have a lower price to earnings PE ratio than the overall market. A lower PE ratio means that the stock is trading at a lower multiple of its earnings than the market average, which suggests that it might be undervalued. Additionally, value investors might look for companies with lower price to book ratios, which indicates that the stock is trading at a lower multiple of its book value than its peers. Another approach to identifying undervalued companies is to look for stocks that had recently experienced a dip in price due to short-term market volatility or negative news. If an investor can identify a good company with a strong track record that has temporarily fallen out of favor with the market, they may be able to purchase the stock at a discount and realize gains when the market eventually recognizes the company's long-term potential. Ultimately, the key to identifying undervalued companies is to do a thorough research and analysis. Value investors often spend significant time and resources analyzing a company's financial statements, management team, and industry trends to gain a deep understanding of the company's true value. By taking a disciplined, research-driven approach to identifying undervalued companies, investors can position themselves for long-term success with the Warren Buffett method. Investing in companies with a strong competitive advantage is important for several reasons. First, a company with a strong moat is better positioned to maintain its market share and profitability over the long term, even in the face of competition or economic downturns. This can provide investors with a greater degree of predictability and stability in their investment returns. Second, Companies with a strong moat are often able to generate higher profits margin than their competitors, which can lead to a stronger earnings growth and higher valuations over time. For example, a company with a popular brand and loyal customer base might be able to charge higher prices for its products or services than a less well-known competitor, leading to higher profit margins and stronger financial performance. Third, a company with a strong competitive advantage may be better positioned to weather economic cycles and market volatility. Third, a company with a strong competitive advantage may be better positioned to weather economic cycles and market volatility. In difficult economic times, companies without a moat may struggle to compete on price or maintain their customer base, leading to declines in revenue and profitability. By contrast, a company with a strong moat may be able to maintain its market position and profitability, even in the face of economic challenges. When evaluating companies for investment, Warren Buffett and other value investors often focus on the strength of a company's moat as a key factor in their decision-making process. By investing in companies with a strong competitive advantage, investors can position themselves for long-term success and generate consistent returns over time. The next crucial thing is patience and discipline. Both are two key tenets of the Warren Buffett method of investing for profit. While it might be tempting to make quick trades or chase hot stocks in the hopes of quick gains, Buffett's approach emphasizes the importance of taking a long-term perspective and staying disciplined in the face of short-term market fluctuations. One aspect of patience is avoiding the temptation to try and time the market or make short-term trades based on market movements. Buffett famously stated that his preferred holding period for a stock is forever, meaning that he prefers to invest in companies that he believes will perform well over the long term rather than trying to make quick profits by buying and selling stocks based on short-term market movements. By taking a long-term perspective, investors can avoid the stress and uncertainty of short-term market fluctuations and focus on the underlying fundamentals of the companies that they are investing in. This can help to reduce the risk of making emotional or impulsive decisions based on short-term market movements and increase the likelihood of achieving consistent long-term returns. Discipline is also a key component of the Warren Buffett method. This means sticking to a well-defined investment strategy and avoiding the temptation to deviate from it based on short-term market conditions or fluctuations. This may involve maintaining a diversified portfolio of stocks, adhering to strict valuation criteria when selecting stocks, and avoiding the urge to chase after hot stocks or trends. By maintaining a discipline and sticking to a well-defined investment strategy, investors can reduce the risk of making costly mistakes and increase the likelihood of achieving consistent long-term returns. This may require patience and the willingness to wait for opportunities to arise, but over the long term, a disciplined approach to investing can help investors achieve their financial goals and build wealth. In conclusion, investing for profit with the Warren Buffett method involves identifying undervalued companies with a strong competitive advantage, focusing on the company's financials, buying the stocks at a fair price, and maintaining a long-term perspective. By following these principles and exercising patience and discipline, investors can achieve significant returns over the long term. While investing always carries risk, the Warren Buffett method has a proven track record of success and is a sound approach to investing for profit.